everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, we are taping this on Friday, May the 6th, and we saw a huge sell-off on Thursday. It looks as though we're continuing to see some damage in the markets today. This, of course, following the Fed on Wednesday, where they raised rates by 50 basis points, very much as expected, and also announced the tightening of their balance sheet, also expected. And we actually saw a rally on Wednesday, but since that time period, we've now started to see the markets really fall apart, might be too strong of a word. So let me bring in our guest today to give us perspective, and specifically within the tech sector, which is seeing the most damage done. Dan Ives is joining us. He's a managing director and senior technology analyst at Wedbush Securities. Dan, great to see you, and thanks for joining us today. Hopefully the markets might settle out a little bit on Friday, and we can have this conversation and it'll air on Sunday. So what's your perspective so far?
I mean, my perspective is that in 6 hours, the market will at least close. And that's probably about the only good thing we've seen this week. I mean, look, at doing this since late 99, I mean, it's a bloodbath, right, for tech stocks. It's been a massive risk off. Post-Fed meeting, we obviously had a massive rebound. And now you're just seeing a deleveraging, a degrossing across the board. You know, I think the massive price dislocation that's happening, we ultimately view it as part of a bottoming process. But no doubt, I mean, I'd say the fears, or I put parallels to what I saw in '01 in terms of dot-com bubble and burst, '08 financial crisis, and probably early days of COVID, March and April 2020.
So when we think about tech stocks, one thing that worries me, and I think this is where you have to be really stock specific, and we are going to talk about some of your top stocks, but what concerns me is if you go back to 2001 and you say this feels similar to that time period, is that valuations, as we know, were high. And for some stocks, even the top stocks in terms of the quality on the fundamental front, it took them 10 years to recover their stock price. So, you know, how do you actually kind of look at technology today? Like if you look at an Apple or a Google, you know, they've pulled back, but you can still see a very, very long, strong growth runway for them. So you don't have to maybe worry as much as you would have in 2001. Is that correct?
Yeah.
Correct.
Well, I think it's a good conversation piece, because look, I mean, if I go back to like .com, 99, 2000, 2001, the average company that we were covering was trading about 25 to 30 times revenues. Whereas today we're looking 6, 7 times. So just from a valuation, from a froth perspective, it's nowhere near where we were. Now, clearly much more leverage in the system. And of course, through the pandemic, there was a work from home pull forward. But I do think like it's a bifurcated tech tape. In other words, right now it's a very strong economy globally. And I think when you look at the overall picture, I mean, you're seeing some price dislocation, but I think you can't also paint tech with the same brush. Shopify, e-commerce names are a lot different than enterprise plays.
When you say it's a strong economy, just because that is so key and critical in terms of many tech names from an enterprise spending perspective, to the e-commerce, the Shopifys of the world. Why do you say it's strong? I feel like we're starting to see some of these economic data points, ISM services for one, start to slow down.
I mean, look, from an employment perspective, I mean, there's way more openings than those that are looking for jobs. So I think it all starts with unemployment in terms of payrolls that we're seeing globally. Inflation clearly is the biggest issue here, which the Fed has to ultimately go after. But if you look at the consumer, you look at debt in terms of balance sheets, you look at the stress test that banks have gone through. I mean, especially even during COVID, I mean, they are as healthy as probably we've ever seen them. So, of course, real estate, you're going to see a little bit of that bubble come out of the system. You'll start to see more of a soften in the economy, but it comes down to if you have a soft landing, and let's call that about a 40% chance at this point, markets pricing in a deep recession and significant fundamental falling off a cliff. So I think we also have to put in context what's being baked into these stocks at these levels.
Absolutely. All right, we're going to take a quick break. When we come back, we will delve into some of the top tech stocks we've been watching this week. We'll be right back. Welcome back. Well, as we are taping this on Friday, May the 6th, we are actually also, as we tape, watching the NASDAQ down another 2.5%. And Dan, I was saying during our little break that, some of your reports, I love your wording. And, you call it the Rubik's Cube in terms of dealing with all the different factors here, a wall of worry, risk off, dark cloud for tech. There's a lot to kind of digest here for investors. And I want to actually ask you, what are you actually seeing in terms of the institutional investor flow? Because sometimes you'll see markets sell off and, and maybe it's just ETFs, cash flow to that. It's not the long only guys or the hedge fund guys that are actually, selling off their positions, but they probably are if they've got some leverage on their books.
Yeah, to just keep with the metaphors, this feels like that video Thriller from Michael Jackson, Nightmare on Elm Street. That's the best way I could kind of explain where we are today because, look, flows have been a disaster. You're seeing redemptions, leveraging come off of the system. And especially when it comes to tech, tech has ultimately been the big bet over the last decade. So now it goes back to, okay, Shopify was 1,600 at the height of the pandemic. Now it's 400. Before the pandemic, it was 400. Does that mean it goes down to 300? Well, what's the price? What's the valuation? So I think right now you're going to see stocks way oversold. I personally believe this is a capitulation. If I look at technically decliners to advancers, the amount of decliners in a given day to advancers, it was 94% yesterday. So once you start to reach those levels, those are capitulation type of numbers, which is important because markets like this for the average investor, they're downright scary. They're scary for the professionals.
Right. But when you take a look at the earnings picture from some of these companies, what stands out on the strong side? Let's start with the positives.
Well, the positives are the enterprise is holding up Rock of Gibraltar like. If I look at software, cloud, look at Microsoft, you look at the cloud numbers from Google, Amazon, even IBM across the board. I think Adobe strong, Oracle, and then ultimately when you look at areas like cybersecurity, that's not going away in terms of needing to protect it. I think names like a Zscaler, names like a Palo Alto, among others. Semis have been strong. AMD was strong across the board. I think you had also strength that you saw in Apple, but of course you got the supply chain and you got the zero COVID issues in China. And that's why you have to parse some of that out in terms of near term versus long term type of issues.
And for a name like Apple, though, even though we are concerned about China and China slowing down because of the COVID and increased restrictions, that's not a name that you would worry about. What is your long-term thesis on Apple?
Demand's outstripping supply by 15%. So that's one where we don't focus much on the supply issues that will get smoothed out. It's on overall demand. I look at Apple as one where the services is alone an $80 billion revenue stream. I think the services business alone is worth $1 trillion plus. So I think, so that's why in names and periods like this, it's in panicky periods, it's Apple we'd be buying, Microsoft, Google, we'd be buying cybersecurity names. I think there's oversold names, even like Snowflake, Datadog on the cloud side, Salesforce.com. And I think that's sort of the way to navigate in terms of quality tech that also can withstand any type of softness in the economy.
How do you, speaking of softness in the economy, how do you explain Amazon's results?
E-commerce was a massive pull forward. What you're seeing is more of a normalization. A Catherine or a Dan now is not necessarily buying as much on Amazon. They're starting to go to the mall. Now, that's not for me. I'm probably buying more on Amazon today than I was even at the height of the pandemic. But I think it just speaks to those are some of the trends that are normalizing. Expenses have increased. They're able to pass that to the consumer. But then you look at the cloud piece for Amazon. I mean, that's massive. I think that's a big part of the sum of the parts valuation. That could be worth $900 to $1,000 alone in terms of that sum of the parts.
Is Amazon a buy here then?
I think Amazon's a buy because of that cloud story, and ultimately what I view as kind of clearing the deck type of guidance that was probably overly conservative that they gave, during earnings season.
Okay. All right. We're going to take a quick break. When we come back, I do want to get your thoughts on Elon Musk and his purchase of Twitter and also Tesla. We'll be right back. So Dan, aside from the massive market sell-off that we're seeing broadly, and also, of course, tech with some real damage being done, the big story really, in tech has been Elon Musk's purchase of Twitter, announced $44 billion, getting some financing from very significant, reputable investors like Sequoia Capital to the tune of about $7 billion, I believe. But tell us your thoughts on his purchase, what it means for Twitter, and also what it would mean for Tesla. There was a bit of concern, I guess, on a financing front, and I don't know how that would necessarily impact, but what's your take on Twitter first?
Yeah, that's been just a major soap opera that will be probably remembered for the ages in terms of Musk buying Twitter. And I think it just really shows that, he started off obviously with the 9% stake. Board thought he ultimately would maybe just get onto the board, eat cheese and crackers in the boardroom, and everything would be fine. But as we know, that's not the way Musk operates. Twitter has been a massive underperformer for the last decade. There was an opportunity to own Twitter. And look, Musk being richest person in the world, leveraging essentially part of his Tesla stake, he's spent about 20% of his net worth on Twitter. And, even though the price he pays is a bit of a head scratcher, it's hard to bet against Musk in terms of what he's done, obviously, at Tesla and SpaceX. It's been an overhang on Tesla just because of the distraction factor potentially being the temporary CEO, as well as leveraging his Tesla stake. But as you saw him bringing in Ellison, Sequoia, Fidelity, and other kind of who's who, it shows Musk is not just doing this alone in terms of turning around Twitter.
It is interesting. He's got a lot of backers, a lot of support, and there's been, reports that other people were talking to him in his ear saying, you should be doing this, you should be buying Twitter. What do you think he's going to do with the company? Obviously it's going to be private. So in other words, it's not for individual investors at this point, unless you already own it. But there's also comments, and I think he'll probably take it public. So what's he going to do? How do you turn around this business model?
Yeah, I don't see public for a few years. I think it's going to take time ultimately to turn this around. Look, I think subscription model is probably the first, much more of a paid subscription in terms of different type of access that people could get. Advertising is key, but it comes down to engagement. That's been the big issue with Twitter from an engagement perspective. They've lost out in the social media arms race. So I think there's a lot of business model changes that need to happen here, probably in the first, 12 to 18 months of ownership. So public, I think that's much further down the road. But for Twitter, it's a loud mouthpiece. It has that captured audience. The problem is engagement, increasing subs and monetizing it. Mm-hmm. And I think subscription is probably the first step that Elon's going to go down.
Do you see his purchase of Twitter and a strategic change and focus impacting any other of the publicly traded companies?
Well, that's been the issue, right? He is the hearts and lungs of Tesla, as well as SpaceX. So any distraction from him is sort of a worry in terms of, for obviously for Tesla. I do also believe that, Musk owning Twitter will eventually be competitive more to the likes of Facebook, TikTok, and others. And that's all going to play out over time. And he's had the golden touch, right? So it's hard to bet against. He likely bring Dorsey in the mold in some capacity as well.
Mm-hmm. What are your thoughts right now on Tesla?
Look, we're bullish on Tesla. Obviously, have been for the last decade. I view it as, regardless of this macro uncertainty, it's the biggest transformation to the auto industry since 1950s. I think Tesla core way to play EV in terms of electric vehicles. There's a lot of competition, but clearly, if you see it, I mean, they are building out in terms of Giga Berlin and Austin, potentially a second factory in China. I think units could double over the next year. And you take out the supply chain, like the demand story is there. The average consumer today has to wait about 8-9 months to get a Tesla. So that's, demand is what we focus on. It's a $5 trillion market, which is why we've always viewed Tesla as a disruptive technology player, non-automotive company, which is why it trades where it does.
Speaking of which, I mean, from what I can see, your price target on it is $1,400. 56 times long-term earnings of $25. Is that correct?
Yeah, that's the best way to view it. And I ultimately view this as any transformational growth name. You got to look out in the next 3 to 4 years. Near term is not the way to view Tesla, in my opinion.
Okay, we'll take a quick break. We'll be right back. Dan, the purpose of my show is really to have these longer format conversations, to talk about items that impact people's businesses, their money, and the markets. So I appreciate your time today. And we've talked about kind of your top-down view, what's going on in the market in terms of the destruction, where there's some opportunities. But I also want to talk about the FANG names. I think a lot of people do own the Facebooks, Apples, Netflixes, Googles of the world. So from your perspective, how much damage has been done? And you have to put this in perspective, because we've also seen years of these stocks performing incredibly well. So what do we do with them today?
Look, I mean, it's been jaw-dropping in terms of the damage, but I think you got to parse it out. Like when you look at Facebook, Meta, whatever name you want to call it, like that business model has been significantly altered because Apple, their iOS changes in terms of targeting advertising. And I think that's been a huge headwind for Facebook. They've also lost out to TikTok, competitively speaking. Now, this quarter was better than rock bottom expectations, but I believe like the hyper growth, the days for Meta or TikTok, TikTok's going to change significantly in terms of what Facebook's going to be doing. Now, I would not be owning Facebook. Netflix, I mean, we've been cautious on that in terms of on the streaming side. I feel like that hypergrowth story hit midnight. So I continue to kind of fade both Meta as well as Netflix. But on the other hand, I'd be owning Apple, Google, as well as Amazon, because I think there's a bifurcation in terms of big cap tech. And I think those three, along with Microsoft, are really going to, I think, be some of the leaders and continued leaders in this tech trade.
Mm-hmm. And so Facebook, though, even at these current levels, what is it, a neutral to you?
It's a neutral. Look, the biggest issue is that they've had so many challenges from the Beltway to Brussels. I mean, we could do a show just on the challenges that Zuckerberg and Facebook have had. The Apple iOS changes, the targeting on Apple products, where you, as any consumer says, do you want to be tracked, yes or no? That goes to the head target of their model. That's been the issue. It's a $10 billion headwind. And I think that's one. Look, every stock has a price, but I believe that's when I'd much rather own the likes of an Apple than a Facebook here.
Okay. And then when you take a look at Netflix, and they had very disappointing results, what do you see going on in the streaming space right now? And when you take a look at a Disney as an example, who do you think is going to lead, or is it just going to be too many players to really be profitable, or as profitable as they need? As we are benefiting from the great content, but it takes a lot of money to make it.
It does, right? $20 billion a year in terms of what you're spending. Look, I think the thing with Netflix is that competition increased. They got hubris, kept passing price increases to the consumer. Churn started to increase it. And if you look at Disney, And you look at Amazon, you look at Apple, remember which one best picture for Coda, like competition's increasing. The average consumer household now has about 4 streaming services. And you go back pre-pandemic, it was 1 or 2. There's a saturation impact. And I think Netflix, you're starting to get to probably oversold levels here. But I do believe that's one, whether it's on the advertising side, maybe like a lower cost advertising model or gaming, you're going to have to see some changes from Hastings and Netflix to start to feel like there's maybe like another growth story that could happen here. The stock's not factoring in.
Okay. And just real quick, Uber?
I think Uber's oversold. It's a recovery story. I think that's actually turned the corner. And that's probably one of the best tech recovery names in terms of this reopening, with a stock that basically many one touch with a 10-foot pole. And that's way oversold relative to how we view, especially going into this, reopening into the summer globally.
Yeah, it seems like it could be an interesting name, specifically just given the damage done. Dan, thanks so much for being with us. And it's so nice to see you again. We've been talking now for years, but it's been a while.
For decade. And it's so nice to be with you. And I think also like, you have such unique insight, not just, that you've done this for so many years, but also being that you came from Wall Street. I think you've always had unique insight into the markets, from my opinion.
Thank you. I appreciate that. And I appreciate all of your insight, and you've got a huge following on a number of networks. So thank you for being with us here on the News Forum. We'll see you soon.
Thank you.